Two investors. Same year, same amount of money. One buys a rental property. One buys an S&P 500 index fund. 10 years later, who has more money? Most people answering that question pick based on what they believe about investing, not what the math actually shows. And the math, when you run it honestly, with all the costs included, produces an answer that surprises almost everyone who hears it. Today, we are settling this debate with real numbers, real costs, real 2026 data, and a conclusion that is actually useful, not just for winning arguments, but for making smarter decisions with your own money. No cherry picking, no agenda. Just the real math on two of the most powerful wealth-building vehicles available to everyday investors right now. Welcome back. I am Warren, and this channel is where the numbers do the talking. If you want the honest answer to one of the biggest debates in personal finance, hit that like button right now, subscribe, and let us run the math together. Let us start by agreeing on something important. The way most people compare these two investments is fundamentally flawed. They compare $100,000 in stocks against a $100,000 property. And that comparison makes no sense because nobody buys real estate with all cash if they are investing strategically. The entire point of real estate as an investment vehicle is leverage. So, we are going to compare these correctly from the start. Our scenario, $100,000 in cash available to invest. Option A, put the full $100,000 into a diversified stock market index fund and hold for 10 years. Option B, use that same $100,000 as a 25% down payment on a $400,000 investment property, finance the remaining $300,000, and hold for 10 years. Same starting capital. Two completely different investment structures. Let us see what actually happens. The stock market scenario. The full honest picture. The S&P 500 has delivered an average annual return of approximately 10.6% going back decades when dividends are reinvested. For a more conservative and forward-looking estimate that accounts for today's higher valuation environment, financial planners commonly use 7% as the real planning rate. Let us use both. At 7% annually over 10 years, $100,000 grows to approximately $197,000. At the historical 10% average, that same $100,000 grows to approximately $259,000. Those are the ending values. What did this investment cost you along the way? Almost nothing. A low-cost index fund at Fidelity or Vanguard carries an expense ratio of 0.03 to 0.05%, meaning you pay roughly $30 to $50 annually on a $100,000 position. There are no maintenance costs, no tenants, no vacancies, no property taxes on the investment itself. If you need the money urgently, you can sell within a single business day. The total friction of this investment over 10 years is measured in a few $100s of fees and a handful of hours reviewing account statements. Tax treatment. Long-term capital gains rates of 15% for most middle-income investors apply to gains held over 1 year. Qualified dividends receive the same favorable rate. Simple, clean, and highly efficient. The real estate scenario, with all the costs actually included. Now let us run the real estate side with the same level of honesty. This is where most pro-real estate comparisons go completely off the rails, because they show you the appreciation without showing you what it costs to get there. You purchase a $400,000 rental property with $100,000 down and a $300,000 mortgage. At 2026 mortgage rates running around 6.8 to 7% on a 30-year fixed loan, your monthly principal and interest payment is approximately $1,970 to $2,000. Add property taxes, insurance, and a basic maintenance reserve, typically 1 to 2% of the property value annually, and your total monthly carrying cost reaches approximately $2,800 to $3,200 depending on your market and property condition. Now, the income side. A $400,000 rental property in a solid secondary market in 2026 generates somewhere between $2,000 and $2,500 in monthly rent. In many markets, that rental income does not fully cover the carrying costs at current rate levels. You may be running slightly negative, break even, or modestly positive depending on the specific property and location. For our scenario, let us assume break even. Rental income exactly covers the carrying costs. That is an optimistic but achievable assumption for a well-chosen property in 2026. After 10 years, what does the real estate position look like? Assume the property appreciates at the national long-term average of 4 to 5% annually. At 4%, a $400,000 property becomes approximately $592,000. Your mortgage balance after 10 years of payments has fallen by approximately $40,000, from $300,000 to roughly $260,000. Your equity position, $592,000 value minus $260,000 remaining mortgage equals $332,000 in equity. But now subtract the transaction costs that are unavoidable in real estate. Buying costs, closing fees, title insurance, inspection, and financing costs ran approximately $12,000 to $16,000 at purchase. Selling costs 10 years from now on a roughly $600,000 property, agent commissions and closing costs will run another $12,000 to $18,000. Total transaction costs consumed over the holding period, approximately $25,000 to $34,000. Net equity after transaction costs, approximately $298,000 to $307,000, starting from a $100,000 initial investment. That is a real meaningful return, roughly 3 times your initial capital over 10 years. Comparing the two side by side, where the math actually lands. Here is the side-by-side comparison that the data produces with honest accounting on both sides. Stocks, at the historical 10% average, $259,000 ending value, starting from $100,000. After long-term capital gains tax of 15% on the $259,000 minus the $100,000 cost basis, approximately $24,000 in taxes owed at sale, you net approximately $235,000. Real estate, with 4% annual appreciation and break-even cash flow, approximately $300,000 to $307,000 in net equity after all transaction costs and before capital gains. On these numbers, with these assumptions, real estate wins, primarily because of leverage. $100,000 controlling a $400,000 asset, appreciating at 4%, generates more absolute dollar return than $100,000 invested directly in stocks, appreciating at 10%. The math of leverage on real estate is genuinely powerful when the property is in a good market and the cash flow is at least neutral. But here is the critical caveat. Change the market, change the appreciation rate, add a vacancy period, add a major capital expenditure like a roof or an HVAC system, and the real estate numbers move significantly. Stocks do not have roof replacements. Stocks do not have a tenant who stops paying rent for 3 months while an eviction processes. Stocks do not require a property manager consuming 8 to 10% of gross rents if you cannot manage the property yourself. The real estate scenario we modeled is a well-executed one. The actual range of outcomes in real estate investing is far wider than the actual range of outcomes in a diversified index fund over the same period. The variables that actually determine which one wins for you. Here is the most practically useful part of this entire comparison. Neither of these investments universally wins. Which one performs better for you specifically depends on 5 variables that are entirely individual. The first is your market. Real estate returns are hyperlocal. A property in a high-growth Sunbelt market with strong job creation and constrained housing supply has historically appreciated at 6 to 8% annually, which changes the real estate math dramatically compared to the national 4% average we used. A property in a market with population decline and weak employment can appreciate at 0 or even depreciate. When you buy an index fund, you buy every market simultaneously and automatically. When you buy a rental property, you are making a concentrated bet on one specific location. The second variable is your cash flow discipline. In 2026, many rental properties in expensive primary markets are cash flow negative at current prices and rates. A cash flow negative property is not necessarily a bad investment, but it means you are writing a check every month in addition to your initial down payment. That out-of-pocket cost has to be accounted for in your return calculation, and it affects how long you can comfortably hold the asset. The third is your capacity and appetite for active management. Real estate is an active investment. Stocks are passive. If your time has real value, and it does, the hours you spend managing a rental property are an economic cost of the investment, even if you never see them on a balance sheet. Many real estate investors who calculate their actual hourly return when time is factored in find that the effective return is lower than the financial return appears on paper. The fourth is your tax situation. Real estate's depreciation deduction, the ability to deduct the IRS calculated annual depreciation of the building from your taxable income, is one of the most powerful tax advantages available to individual investors. On a $400,000 property, this generates roughly $10,000 to $14,000 in annual deductions that can offset rental income or, in some cases, other income. If you are in a high tax bracket, this benefit is worth substantial real money annually. Stocks offer no equivalent ongoing deduction. And the fifth is your time horizon. Real estate's high transaction costs, 3 to 6% to buy, 2 to 4% to sell, mean it is almost always a poor choice for holding periods under 5 years. Stocks are equally efficient over any time horizon from 1 week to 30 years. Here is the honest verdict from the real math. On a pure return basis without leverage, stocks win. The S&P 500's historical 10% annual return significantly outpaces residential real estate's 4 to 5% appreciation. But with leverage properly applied, real estate's return on initial capital can match or exceed stock returns in strong markets, because you are earning 4% appreciation on 4 times the amount you actually invested. In 2026 specifically, elevated purchase prices and mortgage rates above 6.5% have compressed real estate's near-term cash flow advantage and made property selection more critical than it has been in years. Meanwhile, 3 consecutive years of exceptional stock market performance have raised valuations and modestly reduced expected forward returns. The smartest answer is rarely a binary choice. Most sophisticated investors hold both: stocks for liquidity, low friction, and diversification, and real estate for leverage, tax advantages, and income. The question is not which one wins. The question is what combination of both fits your specific situation, timeline, and capacity to manage an active investment. Drop a comment and tell me, are you team stocks, team real estate, or both? I read every single one, and if this gave you the honest math you have been looking for, hit that like button, subscribe, and share this with someone who is still picking a side in this debate. I am Warren, and I will see you in the next one.